Welcome to Dr. Fred Markets. This is not financial advice. Every day, the world of finance, crypto, and artificial intelligence moves fast, really fast, and staying informed is the only way to stay ahead. That's exactly what we do here, together. Let's get into today's video.
Boring index funds just turned into a rigged sports league. S&P 500 today, 733, down a meaningless 0.05%. Flatline, zero drama, CNBC yawns. But under that calm surface, 5 mega cap stocks quietly control over 30% of the entire index weight. You don't own the market, you own a hostage situation. Now check the headline nobody on Wall Street reads: 2026 NBA Draft Grades, live pick-by-pick analysis with AJ DeBonsa at number 1. Sports nerds track wingspan, shot selection, usage rate, contract structure, salary cap impact. That's not entertainment. That's balance sheet analysis wearing a jersey. Third data point, sports franchise valuations are compounding like tech stocks on steroids. NBA team valuations jumped from roughly $1.9 billion average in 2019 to over $3 billion in 2024. Revenues did not double. Narrative did. So here's where your brain should break. The NBA is more disciplined about diversification than your retirement account. Every team needs stars, but they live and die by role players, by depth charts, by cap discipline. Meanwhile, you brag about owning the market while 30 to 40% of your money rides on the digital equivalent of one overpaid superstar blowing out his ACL. Look at today's tape. S&P down a hair, Nvidia down 0.52%. One stock sneezes, and the whole index catches a cold because passive flows keep stuffing money into the same crowded names. That's not diversification. That's a momentum cult. Now contrast that with the only rational thing in today's news cycle. The House passes a sweeping bill to lower housing costs. That's code for the government throws gasoline on an already scarce physical asset with a 30-year demand tail. Translation: boring, mid-tier, cash flow assets win in slow motion while your index fund chases a dunk contest. Here's the mechanism nobody explains on TikTok. Index funds are built like max salary NBA rosters with no bench. They are market cap weighted. The bigger a stock gets, the more your index buys. That's literally buy higher, size larger, baked into the rules. Momentum pumped by rules, not thought. Now think like a GM, not a fan. Signal 1, concentration risk. When 5 to 10 names dominate your portfolio, you're not diversified. You're praying the league doesn't change the rules, the refs don't shift, and your star doesn't age overnight. Earnings miss, regulation hit, or just boredom, your safe index eats it. Signal 2, team construction. NBA front offices obsess over unsexy stats, defensive rating, on-off splits, lineups that never touch the highlight reel. In markets, that's small caps.
Does what you just heard make you want to dig deeper? Good, because that curiosity is exactly what brought you here, and the second part is going to take it further. Let's go.
Mid-caps, international value, boring dividend payers, short-duration bonds, the stuff you mock in group chats. Signal 3, time horizon. A franchise drafts a 19-year-old knowing the payoff comes in year 5 to 8. Your portfolio? You panic sell because Nvidia dipped 0.5% on a Tuesday. Put these together and the angle is brutal. Your so-called passive strategy is more emotional, more momentum chasing, and more star-obsessed than the NBA. The NBA at least has a salary cap. You? No cap. You just keep overpaying for the same stars every paycheck through your 401k. No minutes restriction, no injury management, just max exposure to the hottest name until the music stops. So what do you actually do with this? One concrete thing. Audit your lineup like a GM on draft night. Pull up your actual holdings, not the ticker symbols you think you own. The top 10 positions by percentage. If more than 25% of your entire net worth is sitting in 5 names, directly or via cap-weighted indexes, you're running a 3-star zero-bench roster in a league that punishes injuries. Second, demand role players. Add exposure to equal weight indexes, small cap indexes, and international funds. These act like the 3-and-D guys, the sixth men, the cheap contracts who grind. They don't trend on X. They quietly compound while the stars live on a PE multiple cliff. Third, stop worshiping daily price flickers. A 0.05% move in the S&P is background noise, not a signal. Real signals come from structure, concentration, liquidity, and where new forced buying flows enter the system. Right now, those flows feed the same megatech monsters. That train runs until it doesn't, then everyone learns the same lesson in one violent week. Truth, the NBA understands portfolio management better than your brokerage app. They diversify skills, contracts, ages, and risk. You blindly stack whatever SPY and QQQ shove in your face. This is not financial advice, but here is the truth. If you don't know your portfolio's top scorers, usage rates, and bench depth, you're not an investor. You're a fan wearing the jersey of the market, cheering for a team you don't control. 3 takeaways. 1. Index funds are not neutral. They overweight the loudest stars. 2. Real risk lives in concentration, not in daily volatility. 3. Treat your money like a franchise. Build a roster, not a poster. You pick. Stay a spectator in the star cult, or become your own GM and actually draft a portfolio that makes sense. This is not financial advice. If you enjoyed this video, please subscribe to the channel and check the links in the first comment below.
That's a wrap for today on Dr. Fred Markets. I hope this gave you something to think about, a new angle, a clearer picture, a better question to ask. Remember, this is not financial advice. Do your own research, always. If this video added value to your day, subscribe. It's free, it takes 2 seconds, and it's the best way to support this work and keep it free for everyone. You'll also find every video as a full article on the blog, drfredmarkets.com, and the newsletter is in the bio. I'm Dr. Fred Markets. See you in the next one.